Good morning and welcome to the Glenigan live webinar. Apologies for keeping you waiting. As with all live things, we've experienced some technical difficulties, but we are back up and running now and aim to bring you all of the excellent content that we had planned to. So my name is Victoria McEwen, I'm the Managing Director at Glenigan, and today I'm joined by Robert Davis, our Content Director.
Good morning.
And Alan Willen, our Economics Director.
Hello.
So we're going to be with you over the next 45 minutes talking about how the UK construction industry can bounce back from this current situation. The market is experiencing an unprecedented period as the coronavirus has made a dramatic impact on the country, but it's also starting to show telltale signs of recovery. Previously suspended projects are resuming activity on site, and the early development pipeline is showing positive signs of recovery. In a week where the government has actively encouraged our construction workers to return to sites, extended the working hours for those sites, furlough schemes have been extended till October, and we have seen our GDP drop 2% over the first quarter, we ask ourselves, what can we expect to see over the coming weeks and months? To answer that, Robert and Alan will be sharing their insight into what the market has been experiencing, what the current state of the market is today, and where we see the influencing factors going forward. We'll be running a Q&A session with you shortly, and if you're watching this live, then please feel free to submit your questions in the comments section of the screen. But firstly, Alan, would you like to give us some insight into exactly what's happened to the market during this period?
Yes, thanks, Vicky. Well, construction activity has clearly been severely disrupted since the COVID-19 lockdown came into force in the middle of March. This week, we saw official data released by the National Statistics looking at construction output, which fell by 5.9% during March. And that's really the impact of those cuts in the second, of activity in the second half of the month. And clearly, we'll see far steeper declines will be recorded by ONS in due course when the April data comes out. The government also conducted a survey during the first half of April of businesses and found that a quarter of construction firms had suspended all operations at that point, and that 4 out of 5 firms in the industry had also reported a fall in turnover, and a similar proportion of firms had also furloughed at least some of their workforce at that point. Now, subsequently, we have seen a gradual improvement in construction activity, with the initial easing in by government of the lockdown restrictions coming into effect this week. Glenigan researchers have identified a growing number of suspended projects where work is now restarted on site or which are currently being prepared for a restart over the next few weeks. Over the last week, we've seen an increasing number of those suspended sites restarted by contractors and developers. Currently, there are about 2,823 suspended sites as of yesterday. Now, that's a 6% fall on a week ago. Suspended sites currently account for a third of all sites currently under construction and for 34% of work by value. Now, this compares with 37% of sites and 38% of work just 2 weeks ago. So we can see we are on a gradually improving trend. And the improvement in activity has been very much in England and Wales, where 27 and 24% of sites respectively are currently suspended. This compares with around 78% of sites in Scotland and Northern Ireland, where there's been no increase in site activity. And that very much reflects the fact we've got much more extensive shutdowns being implemented and maintained by the devolved authorities in those two countries. The declines in England and Wales are due to the reactivation of a growing number of sites as contractors developers adapted those sites to include social distancing. Work has resumed on 17% of sites that were initially suspended at the outset of the lockdown. Larger sites in particular have been reactivated, and as a result of that, if you're looking in sort of value of work terms, a quarter of construction workers that was initially suspended is now back underway. Now, that actually, given the headlines, we've seen numerous headlines we've seen over the last couple of weeks about house builders and contractors announcing that they're returning to work. That might seem like a relatively low proportion of suspended sites. And that's because those headlines really are picking up on a number of, there are basically announcements on what's being planned. And in many cases, those sites are currently being prepared for a safe resumption of work rather than actual work actually now starting on site. There's a lot of work that needs to be done before construction can be resumed. Often we're finding out that there's a widening of walkways going on, the introduction of one-way systems around the site, alongside staggered working hours, greater PPE provision, and additional site supervision. All those are the sort of elements that are having to be introduced by contractors before construction activity can resume. Now, accordingly, as a result of that, we should see a further acceleration in site reactivations over the coming weeks once these measures are all put in place. To date, it's the civil engineering, office, health and education sectors that have seen the most widespread reactivation of sites. For example, work has restarted on 28% of suspended education projects and 32% of health projects. In contrast, looking at the more private sector areas, hotel and leisure, retail, and especially residential projects, these have been relatively slow to restart. Having said that, over the last 2 weeks, we have seen a growing number of residential projects being reactivated. Currently, 16% of suspended private housing projects have been reactivated, and that's up from just 3% at the end of last month. Now, the phased program of reopenings we've seen announced by the major house builders should further boost this total over the coming weeks. Moving away from the suspended work pattern and looking at sort of project starts, there's a similar pattern that's been at work there in terms of project starts. The Glenigan Index, which tracks new construction activity by looking at the value of new projects starting on site, excluding the high value projects of 100 million or more, just to give a view of the underlying market conditions. The index recorded a 37% fall in the value of project starts during the 3 months to the end of April, against the same period a year ago. And really much of that fall was due to weakening in project starts during the closing months of March, weeks of March, and then a sharp fall over the last month. The value of starts in April, for example, were half the level of a year ago. Now, whilst we expect project starts to remain sparse this month, I think the progressive reactivation of existing sites points to a partial recovery in starts as contractors apply the same social distancing practices to those delayed projects. The immediate pipeline has also weakened since the lockdown came into force. At 395, the number of main contract award last month was about 60% lower than a year ago. Now, the value of underlying contract awards, excluding those major projects of 100 million or more, was almost half the level of a year ago. So you can see there's a sort of similar drop to the decline we saw in April project starts. Now, whilst dramatic, there are related indicators that do suggest that these declines will be short-lived, or the extent of these declines will be short-lived. An average of 59 new bidders a day were added by the Glenigan researchers against projects this week. Now, that's 35% fall on the number prior to the lockdown, but that's a smaller decline than we've seen in contract awards and project starts. And this suggests there are a number of factors at work here. Whilst the fall in the number of bidders and contractors in part reflects greater caution among clients to commit to projects in the current economic climate, the fact you've got a smaller decline in the number of bidders does suggest that the average tendering process may also have been extended during the lockdown. Now, this may also in part be due to delays in decision-making processes. Key staff are working from home, for example, and that's exacerbating the short-term drop in contract awards. Accordingly, there may be a progressive recovery in invitations to tender and contract awards as the gradual easing of lockdown restrictions unfolds over the next few weeks. Furthermore, the early development pipeline also remains relatively firm. The number of planning applications being published by Planning Authority averaged 1,523 a day over the last week. Now, actually, this is an 8% rise on the previous week, and it's just 3% down on the daily average we saw prior to the lockdown. at 1,264, the daily average number of published planning decisions is 11% lower than we saw prior to the lockdown. So a decline, but nothing to the same extent that was seen from the more immediate response to the COVID crisis in terms of project starts and contract awards. Now, the decline in applications and decisions on large projects has been greater, as I was saying, than the applications, dropping by 19 and 30%. Now, the sharper declines in larger projects may reflect delays in compiling and submitting supporting documentation for those larger projects. Accordingly, an easing in the lockdown may prompt an upturn in applications over the next few weeks, all of which suggests that the industry potentially faces a growing pipeline of planned and suspended projects as the lockdown is eased over the next few weeks. A pipeline of work that will have to be delivered whilst the industry adopts the new social distancing working practices on site. This hopefully provides an overview of the current development data and activity. Rob will now delve behind the numbers to look at what researchers are finding is going on the ground.
Okay, thanks, Alan. So, as you'll know, Glenigan uses thousands of sources of data to build the most comprehensive view of the construction industry. But the most valuable is our team of over 110 web and phone researchers who make well over 1 million phone calls a year into the construction industry, speaking to the key decision makers. This gives me the opportunity to share with you some of the anecdotal insights that our teams are hearing to support the statistics that Alan's just given you. The key thing to note is really that the impact is not uniform across the whole of the UK, nor is it the same for every sector. Private housing is particularly troubled, I think, at the moment, due, on the one hand, of course, to the impact of the COVID-19 restrictions, but also, on the other hand, via the severe reductions in demand for the completed homes. It was only really on Wednesday that the real estate industry came out of lockdown, and the impacts over the last few weeks, couple of months, I think is demonstrated by the ONS when they suspended their house price indices after March's figures due to the extremely low, virtually zero, level of transactions that it means it would be difficult to produce any meaningful house indices at all to reflect the market, given that the market is potentially, pretty non-existent. So I think coming out of that, the key questions are really, will all the stalled purchases complete? Will transaction levels fall due to uncertainty over people's household finances going forward? And another interesting one is, has the demand for inner city flats declined in favour perhaps of more suburban properties with gardens and outside space? Apparently, only around as much as 12% of UK homes have no outside space. And I think that's going to really become a premium going forward. Now, the government is obviously trying to stimulate the market. They're allowing the working of longer hours. Sites can stay open until 9 p.m, including Saturdays. And apparently they're also even considering night working and Sunday working as well, and working on shifts. And as you've heard from Alan, thousands of sites have now recommenced activity. But it's not anywhere near like the productivity levels pre the COVID impact. In fact, there was a house builder Twitter poll that I noticed just a few days ago that showed that 54% thought the majority of house building sites wouldn't open up again fully till June. What we're seeing in our research, and we're hearing from our contacts, is that the sites furthest away from cities are the most likely to restart first. And house builders are really prioritising the sites that are nearer completion, just so that they're not having to use so many heads on those sites. Productivity, as a result of this, is well down on work levels before the lockdown, averaging just 71%. Having said that, that's up from 67% last week. And sites in London remain a particular challenge, and I guess that's through the reliance on public transport. But the productivity on sites in London is only down at 63%. Now, across the house building sector, we're hearing from a lot of the big developers. Persimmon have announced yesterday that they're getting 65% productivity on their sites, but they didn't furlough anyone. So you can see the impact that the restrictions are having. Cala Homes, their site management teams are back on site to prepare to open, and they're expecting their subcontractors to start joining, but that's going to be staggered over the next few weeks. Taylor Wimpey have told us that the sites down in the southwest, where the COVID outbreak has been relatively low, have all commenced their construction works now. And the majority of the rest of the sites are going to commence between now and the end of May. They're asking their furloughed construction staff if they're happy to come back on site, and if they're not, they can stay on furlough until the end of June. But they have a plan in place to bring every site back to full operation. We spoke to Tom Roberts, Redrow's Group Communications Manager, only earlier this week, and he said that site managers have started back from this week to get all their sites back ready for construction to start, and they're hoping to get all the sites back, apart from the Welsh ones, back by the 6th of July at the latest. They had furloughed quite a lot of their staff, but they're not making anyone who doesn't feel safe to come back to site. So the plans are there, but the projects will be, I think, prioritised by the likelihood to sell the completed homes. And obviously a lot of local factors will play into that. Now, I think this has been received quite relatively well. We've seen that the top 10 house builders' share prices have recovered slightly. They dropped around 50% in March, but they have recovered by over 10% already. And in terms of the other sectors, we're seeing it's sort of similar in social housing. We've spoken to a lot of the large housing associations that have their own construction arms, and they're telling us that they are also starting back on site this week. Now, in terms of moving away from residential sector, I think it's been noted by a lot of commentators, I think, that the lockdown will change society in lots of ways. But I think the first things I think we're seeing are an acceleration of trends that were becoming established anyway pre-COVID-19. So things like cashless payments, for example, have become compulsory. Supermarket deliveries have doubled, and everyone's buying a lot more online. So I think the impact for the commercial sectors, I think, will follow a lot of this. Retail's obviously been devastated. It's been in trouble for a long time with a string of further business closures as the lockdown pushes further retailers over the edge. And I think also many businesses are now realising more that they can operate perfectly well with home working. And as a result, the demand for grade A office space in central city locations is bound to be affected, I think. One of the largest developers in this space, Land Securities, this week said, flexibility allows us to keep reviewing the occupational market we might deliver into and to decide at multiple junctures whether to continue work, pause, or cease speculative development entirely. We know that several of our partners and customers are reviewing their office strategy and downsizing their requirements. However, our pipeline of new office developments does remain relatively strong, as Alan's pointed out. And there's been a historic undersupply of grade A office space, particularly in London. So this situation, I think, generates opportunities in the short term, maybe for more fit-out opportunities and remodelling existing offices to suit changed working procedures. So that's the commercial sector and residential. I think in the public sector, it's really a different story. Projects have been prioritised here, and a lot of them have continued work right through the lockdown. Healthcare, education, infrastructure and utilities are all progressing strongly, with positive signs that the government could actually be preparing further investment in all of these sectors to help try and kickstart the economy again over the next few months. The only other section in the private sector that we have noticed that is potentially more of an opportunity is distribution centres and warehousing. That has a very healthy pipeline, which is only going to be increased as more retailers invest in their online offerings. And then I suppose regionally, again, the picture is very mixed. as the devolved administrations in Scotland, Wales and Northern Ireland have not yet followed England's lead in starting to ease the lockdown. Although I was reading this morning that Wales is starting to prepare to ease more. Our figures show that while only around a quarter of the sites in England are suspended, the figure shoots up to around 80 to 90% in Scotland and Northern Ireland. The Northern Irish market is inextricably linked to the Republic, of course, and a similar easing of restrictions announced there should lead to more site resumptions in time, although I think Scotland stubbornly politically remains closed for the medium term. So hopefully that gives a good insight into what we're hearing on a regular basis and in terms of what's happening in the market right now.
Thank you, Rob and Alan. It's interesting, isn't it, that although the market has been significantly impacted since the March lockdown, we are starting to see some emerging bright spots, particularly around the future investment of the public sector and the planning. Inspectorate announced today that it's going back to recommence its site visits to push some of those infrastructure projects along. So that's particularly a good sign, as well as the good week-on-week increase and improvement in site openings and planning figures, which again shows us that there's activity in the market and there's some hope and light at the end of the tunnel, as it were.
Yes.
So look, now we are going to move to questions that you, our viewers, have been submitting to us whilst both Alan and Rob have been talking, and some questions that you submitted before the webinar. So look, question one, and it's one that perhaps we might need a bit of a crystal ball for, but when do we realistically feel that construction will get back to the levels that we have been seeing in 2019?
Well, I think, again, it's a story of two halves, really. On the public sector side, not long at all. It's not been too badly hit. It's going to get this priority funding and investments. And so I think it really could bounce back really pretty quickly. And as I say, it's not dropped that much to start with anyway. The private sector is a different story. But again, it's varied within that. House building could bounce back, but it will be changed, the type of housing to be built. I think retail is incredibly troubled, and offices may be impacted more medium to long term. In terms of getting back to the levels of 2019, I think I would say 2022 at the earliest. Alan, what would you say?
I concur with that. I mean, if you look at the overall picture and look at the wider economic picture, for example, prior to the outbreak, OBR was forecasting growth, but very weak, albeit very weak growth for the UK economy over the next couple of years, sort of about 1.5% per annum. And then in that environment, we were envisaging that we will gradually start to see some growth in construction output. We're now looking at a situation where we've got a very sharp drop this year, and I think the latest OBR and Bank of England forecast is that we're going to make up, hopefully, a lot of that ground next year, but we won't, the economy as a whole won't be back matching 2019 until, at least as you say, 2022, the end of 2021 at the best. And I think construction is very much going to follow that pattern, and it's very much because of that weakness on the private sector side that you referred to, Rob, that we're going to see it's going to take time for recovery, investment and confidence and demand from a private sector point of view to feed through into construction activity. So, yes, I think the private sector is going to be not across the board, but by and large, I think it's going to be the relative area of weakness, which is going to hold back overall construction output. But I think there's going to be some growth opportunities, particularly as you were saying, in the education, health, and on the civil engineering side. And we've already seen some big projects that the government's been keen to push ahead. And after much delay, for example, HS2 is now back on stream and under construction, and that was something that happened during the lockdown. So some positive news is on that front.
Certainly. And so with I suppose, a long period of recovery ahead for us, it's going to be even more important for our clients to be focused on those growth areas and to really be able to explore those opportunities that we're talking about in the public sector around health, education and infrastructure, and particularly around those around the distribution, warehouse and logistics as well, so that that they can really capitalize on the growth areas for their own businesses as well.
That's right.
Yeah.
Okay, well, moving to the next question, and this is around, and we have touched on this in your updates, but how will the commercial sectors fare post-COVID? So we've touched on retail. I think office and hospitality is an interesting area to look at. Rob, Alan, what do you think?
Rob, I don't know if you want to talk about the hospitality side of things.
We've covered retail and offices already, I suppose, but I think hospitality is a really interesting sector. It's obviously probably the most impacted sector by the lockdown. And I think at the same time, it's the sector that people seem to be missing the most. So therefore, as soon as the lockdown, let's hope looking forward that we'll have a vaccine, it will be widely available, and everything can return to normal. Let's assume that happens, end of this year, start of next year. If that happens, I could see the hospitality sector having a real bounce back very, very quickly, because I think demand is going to be there. So I think it really does depend on when we can get back to normal. So that relies clearly on the medical research and the infrastructure in being able to distribute a functioning vaccine, really.
Yeah, I think that's it. It's that return to normal element. I think on the office side of things, I think it's just sort of picking up on something that Rob was saying earlier on about actually the sort of the outbreak reinforcing existing trends, and I've seen this before in other areas. A good example of this was I've always cycled into work in London for sort of 35 odd years. I think I was the only cyclist on the road when I started, but it's been a gradual improvement over time. We see more people cycling. I think Boris painted the parts of the road green at one point or blue to try and encourage people to cycle a bit more. There was a whole load of different initiatives, and then 7/7 happened, and literally overnight the number of cyclists on the road doubled. There was a sort of complete reappraisal of risk and what people wanted to do, and that really sort of spiked and it reinforced a trend that was already there. And I think we'll see
people didn't want to use public transport.
They didn't. So yeah, and we're seeing that obviously the government's trying to encourage people to do that again now. But you can see the similar sort of trend, I suspect, in the office market. If you look at office construction and the existing stock actually over the last sort of 20 years, there's been a progressive increase in the number of offices, but the average size of those offices has been gradually and progressively declining over that period. And that's a trend that I think this will get reinforced potentially by the current crisis. It's forced us all to work remotely in a lot of cases, and for businesses to reassess actually, yes, this can work. There are some benefits from it, and there's some downsides as well. So I think there will be a return to offices, but I think how we use that office space will change, and I think that's going to be in the short term. You've got to try and have some sort of social distancing involved there. But I think longer term, it's also going to be perhaps more of a fundamental change about how we use that office space. If more people want to work, or it works for businesses for more people to work remotely for most of the time, how are you going to use that existing office space? People are going to perhaps want to use that in different ways to come together, and more meeting rooms, more sort of collaborative spaces than perhaps we've got in the past. But people dipping in and out, and you're going to need very good telecommunication both at home and in the office to enable people who are remotely working to sort of dial in and link up. Not all businesses are in that state at the moment, but I'm going to see massive investment, I think, going forward to really capture the benefits that we've been sort of trying to adapt to over the last sort of couple of months.
Mm. I mean, it's true, isn't it? Our consumer behaviour will have a huge influence on the shape of our industry going forward, and the confidence and the fear of us, in us individuals, and our comfortableness to go back to offices and operate in the way that we have. So our new normal will actually impact how the industry shapes itself in the coming weeks and months and years, in fact. Okay, so just moving on to the next question. This is two questions in one. So this is all around the supply chain for goods and materials. And how do you think that they're going to be impacted by the pandemic and the lockdown? And do you have a view on the impact on construction costs?
Right. Well, the vast majority of products are used in UK construction are actually manufactured in the UK. So therefore, only around 26% of materials are imported. However, the UK does import a high proportion of certain materials like timber products, mechanical, electrical components, that sort of thing. And with those, they are imported 62% from the EU and 16% from China. Now, obviously, both those regions have had extensive shutdowns. And so what I'm thinking is that product supply may be interrupted for specific product lines. And obviously, I think stockpiles may start to run low as well. So it could be that certain elements in the build are impacted. And if they're crucial elements, obviously, then that stops the build entirely. And, certain times you can work around it, but other times something will actually stop you being able to progress. So therefore, I think that could become a bit of a problem. But I suppose that the fact that the lockdowns in different countries have been staggered, and that work in manufacturing has been able to restart in some areas, particularly China, ought to mean that that the supply is able to recommence and to pass through. But Alan, what are you hearing?
Yes, I mean, I think there's still, again, as you say, most of the products are UK manufactured, that are used by the construction industry. But even here, we have seen, obviously, the fact that manufacturing has been offline for a while and gradually starting to come back in a number of cases. We've seen some positive stories on the brick industry on that front, but I think other areas, plasterboard, for example, they're taking a while in terms of UK production. British ships is taking time to get back online, for example. And I think at the moment it sounds like they've got a sort of a rationing, effectively demand management process in place to try and ensure a fair distribution of product. So that is, particularly as the industry gears up, that could potentially be a break to the pace of development. Having said that, as we were hearing earlier on, more sites are opening, but they haven't got the same level of productivity and the same pace of construction. So hopefully there'll be sort of some coordination there. And I think that's going to be one of the challenges, I think, for the government, as well as and the UK generally, as we gear up, is that, yes, you can get the construction online, but you've got to make sure manufacturing is coming back and other services are coming back that support construction, just as the construction supports other parts of the economy. So it's got to be there's got to be some synchronization there, I think, to really make sure we don't have the unnecessary bottlenecks.
I think most of the merchants have continued to stay open throughout the lockdown, haven't they? I mean, they've adapted in the same way as other retail outlets have. There's a lot
click
more
and collects, pre-delivery, pre-ordering,
call and collect and pre-ordering, that sort of thing. So, but quite right, as demand increases through sites coming back from suspension, I mean that's not as quick and simple and easy way to purchase materials, and so the delay, there will undoubtedly be delays associated with that as well.
Interesting times. Look, we'll move to our next question, and we've touched a bit on this, Rob and Alan, both in your updates, but around the private housing sector and the wider residential market, and how do we expect that to perform over the next couple of years? What are the big impacts that we think we're going to see there?
Yeah, so I noted this week that both two of the biggest property agents, Knight Frank and Savills, noted that there would be a drop in house prices between 5 and 10% by the end of the year. They were both pretty consistent around that. But also I heard that Zoopla and Rightmove are reporting significant increases in online viewings. So there does seem to be some kind of picking up in activity there. I think
Appetite to move.
Yeah, absolutely. I think it would be interesting, as I mentioned earlier, as to whether all of those potential purchases which were in train as we went into this, whether they'll all complete or not. Because what we're hearing is that people are getting maybe cold feet over certain things because they're worried about their future finances. That's one side of things. Also, they're reconsidering what their priorities are. You know, is it good to be in the centre of a big city, reliant on public transport, but with no outside space, but with a really short commute, as opposed to having a much longer commute, but with not having to rely so much on local public transport, having outside space, having a garden, that sort of thing? Because, of course, if you're only going to go into the office once or twice a week, then maybe that's a bit more attractive to you.
That's where that impact of consumer behaviour just comes in massively, doesn't it? With us all moving to working from home more, maybe, and our priorities change. Suddenly, living out of the big city might be a really appealing thing.
Yeah, I think it's going to be a great. It's going to be interesting to see how that plays out over the next couple of years, I suspect. So I think it's going to be a gradual thing, and it's going to be a new challenge for house builders, for example, in the way they design their homes. If more people are remote working, then actually you're going to want to make sure every new house has a really good internet connection. It doesn't matter where it is in the country. And there's also some space that can be adapted to it. It doesn't have to be an office in its own right, but it's going to be some space that's readily adapted to that. And if you do that, that's going to be a real marketing opportunity, I suspect.
I think the other thing I'd noted this week was that across the board, the interest rates being offered by the major lenders are down by 0.35% on what they were at the start of the lockdown. So therefore, there's some real impetus being injected by the financial sector into stimulating the housing markets. They're really looking to drive activity there. So I think that's very positive, and that's obviously coming from the fact that interest rates have dropped to historic lows now. So if you want to make that leap, it's the best time to buy a house from that perspective.
Okay, thank you. A question just in on the feed. Will airport expansions be affected, i.e. Heathrow? Well, I think we've seen some impact of that already, but perhaps you can give us your thoughts.
I think Heathrow third runway, I think it's already been announced, is probably not going to go ahead now. And we've heard that BA are considering pulling out from Gatwick and making their hub Heathrow. So absolutely, we can see that straight away. I mean, it could be that in a few years' time, if looking forward, if there's a vaccine, we can go back to normal. This sort of thing. Maybe there will be demand for that again. But certainly, it's been pushed off by, I would suggest, at least 3, 4, 5 years, if at all.
And the regional airports as well. The regional airports will be massively impacted by this because they will be used so much less, won't they?
Yeah, well, we've already lost some of the big regional. Flybe, for example, has already been lost. So those are the big sort of gaps in their
big impacts in Southampton, particularly.
Yeah. And I think the other interesting thing is, yes, I think there's obviously clearly a lot of nervousness now. It's going to take time for people to return, particularly from the holiday perspective, to flying abroad. But it's going to be I think the business side of things is going to be interesting, because actually, if there is, if it is starting to change behaviour in terms of better, more effective use of technology, like we've managed to get working today after some delays. Yes. But if there is more use to that, then from a business perspective, do you need to be jumping on that plane and flying to China for days, set of meetings, and then traveling all the way back again. So that could have a huge impact on the demand from the business perspective, which has implications for the whole fare structure of the airline business. I would put, and clearly then the demand for airport capacity as well.
Indeed. Okay, so just time for probably 2 more questions now. And look, Brexit was all we talked about, wasn't it, for so long in our webinars and our roundtables. And we have a question on Brexit, which is almost refreshing. But over the last year, obviously Brexit has dominated all discussions. How much impact will the end of the transitionary period come January 2021 have?
Okay. So I am reliably informed by a government minister that the transitionary period will not be extended beyond 31st December 2020. So we know that's the headline. I know there's been lots of talk about potentially how it could be extended and this sort of thing, but only last week I was reassured that is not going to happen. So therefore, we need to be able to prepare for that. I think it's really interesting that obviously the big worry, I think, was around getting labour into the country for sites after Brexit. But in terms of labour supply, I think that COVID-19 has had much more of a restricting impact on getting foreign nationals into this country than Brexit ever could have done. So we're already in that situation. Materials is an interesting one, I suppose, because it could force contractors to have to switch to more expensive domestically produced products, but then the silver lining to that would be that that would be the positive impact on UK GDP and on UK manufacturers. So Alan, what do you feel about the wider macroeconomic?
Yeah, I'm slightly more apprehensive in some respects, I think, because I think we already knew that it was going to be a hit, particularly if there was we're in sort of a heading for a hard and fast, sort of almost like a no deal exit, which, as you say, Rob, looks like is the way things are going to play out. Now, the impact of that, I think, will get masked by the fact that we're going to see a sharp drop in construction activity in GDP this year, and a bit of a bounce back next year. We will see a bounce back next year that hopefully will take us back to nearly where we were in 2019. So that's going to mask a lot of what's going on. But I think in terms of the issues it's going to raise for the construction industry, I think they're still going to be there. We mentioned earlier on how most of the stuff we use in the UK material wise is UK manufactured, but often obviously those products are manufactured with imported components, and about 26% of stuff is imported as well now, and 60% of that's from the EU. I think at a time when I think the danger is at a time when Europe and the UK, other parts of the world are all starting to recover from COVID. We're starting to get manufacturing capacity up across the globe. If you're a manufacturer, and you've got perhaps more demand as a result of that than you currently, as you're gearing up, can supply, you're going to supply where it's easiest and most cost effective for you to supply, which is going to be locally. And I think that's going to be the danger from a UK manufacturer, that we won't be part of a wider market anymore. So local will be UK. It won't be from Italy or Germany in the same way. So that could actually be something of a barrier to activity, I fear, and the pace of recovery over the course of next year.
There could be a switch between the sort of material used, moving from maybe if concrete tiles become more expensive, then maybe switch back to slate, or I mean, at the moment it's much more expensive. But it's,
I think that's going to be the thing for I think contractors, architects, and specifiers are going to have to. I think going to be flexible and plan ahead, I think.
So we could see a lot of changes and change of detail planning applications coming through potentially to amend existing planning permissions that maybe in the new normal it's required to do things slightly differently, use different materials, and potentially even, as you were saying earlier, redesign the layout of offices and homes.
And I think that's something that the planning authorities are going to have to be more flexible on, and planning officers perhaps as a result.
Okay, so time just for one more question. We've got a great number of questions coming in on the feed, so we're not going to be able to answer them all today, but we are going to do our very best to answer as many of them that we can over our social media platforms. So if you haven't had your question asked today, rest assured we'll do our best to answer it after the webinar. But final question, and one that's been sort of a running theme of questions as they've been coming in. If you were standing in our client's shoes today, where would you focus your efforts?
Okay. Well, I think overwhelmingly public sector, really. That's where we see the least amount of impact so far and the quickest bounce back, and probably the area where there'll be most new cash injected, if you see what I mean.
And civil engineering as well, I think.
Most of civil's work is proposed by government, isn't it? So I think health, education, civil engineering, the infrastructure side, as you say, you can imagine that there'll be a massive demand on higher quality broadband for homes and businesses. City Fibre and Virgin investment there. That's obviously a huge opportunity there. Health, that stands to reason. There will definitely be more investment in health, and the government has the ability to invest more in education because, of course, again, borrowing is at all-time lows. So therefore, pumping more money into the sectors that it can, such as health and education, means that stimulates the economy, and that's obviously what they'll be looking to do over the next few months. Maybe social housing as well. Maybe that's an area that the government can invest in as well. Yeah. I think private sector it's much more challenged, of course. The bright spot that we've mentioned, of course, is distribution warehousing, probably built along the spine of Britain. I think that's interesting on that, because I think the big logistics warehouses, I think, yes, they're going to remain sort of Midlands, bits of the southeast, northwest. They're going to be the main sort of location for those because of that distribution spine that you mentioned. But I think one of the areas that we've picked up on, and I think it's going to get intensified actually by the current crisis, is that final mile support to get their product to people's households. So I think you're going to see investment in much more in these sort of localized distribution hubs. Interested to see how that plays out, because I think one of the things that that's been mentioned is that to us is that one of the sort of target areas may well be a lot of these out of town retail business parks, where Homebase used to be located, that could well be sort of targeted and redeveloped to provide logistics hubs for that online delivery services. So so it's reach essentially the big stuff, but I think it's going to be across the country.
Right. Well, unfortunately, gentlemen, we're going to have to draw this discussion to a close. We've run out of time, but I think it's really important that we do just finish reminding ourselves that although we are living through this unprecedented time in our lives, there are some positive trends emerging, and it's important for us to remind ourselves of those. So the opportunities arising through the expected and increased public investment in infrastructure, health and education are particular bright spots. Ongoing and improving trends around the around site openings, particularly the reactivation of our large construction sites and the great week-on-week improvements we're seeing in those site openings, and also the expected increased demand in warehousing, logistic and distribution centres, and the execution of that final mile, as you said, Alan. So look, for now, all it's left for us to say is, look, thank you for joining us today. We apologise for the technical issues at the start of the webinar, but glad we've managed to get through it. Obviously, if you require any specific analysis in your particular sector, we are here to support the industry, so please do get in contact with us. We're all operating in a constantly changing landscape, and we will do our best to keep you up to date with that changing landscape as we go through the weeks, months and years going forward. So for now, myself, Rob, Alan, we wish you all the very best. Thank you for taking part in today's webinar. Stay safe and goodbye.
Goodbye.
Goodbye.